Good evening, everybody. Welcome back to Strongman Personal Finance. I know it's late. I'm usually in bed at this time, but I was inspired to make this video. Cloudflare. Cloudflare. One of those high growth, massively overvalued stoinks that is kind of being pushed on YouTube. Now, apparently, Meat Spin Kevin, if you don't know who that is, you don't need to know. Don't look him up. But apparently, Meat Spin Kevin was pumping the stock. I couldn't find any evidence of that, so I'll give him the benefit of the doubt. But I would not be surprised if he did, because this stock is freaking expensive and it's massively overvalued, in my humble opinion. Now, if you don't know who I am, Christopher Bell, certified public accountant, long-term boglehead investor, author of the book Stop Being a Broke Loser. It's on Amazon. And I'm a hater of YOLO speculative clown investing. That seems to be all the rave now on the internet, on the YouTubes. So let's go check out Cloudflare. Let's see what it's all about. And then let's go look at some of the financials. And then I'm going to go to bed because I'm kind of tired. So here we have Everything Money's software. Make sure I'm sharing my screen. Yep. Here we have Everything Money's software. Now, as you can see, Cloudflare, ticker symbol NET, is currently trading for $191 per share. And it went down 4.5% today. Oh my God. Now, the first thing I noticed when I looked at this, price to sales ratio, 102. So for $1 of sales, you have to pay $102. Not earnings, sales. That's the top of the income statement, not the bottom of the income statement, okay? So even if they have a 50% profit margin, you're still paying a PE of 204 for a freaking stock, which of course are not profitable. I think they will be one day, but they're not profitable right now. So that really jumped out. It's like, holy crap, 102 price to sales, $60 billion market cap. That's a pretty big freaking company. $60 billion off $588 million of revenue. That's freaking madness, okay? And from $588 million in revenue, they lost $216 million over the last 12 months. The only encouraging sign about this company, ladies and gentlemen, is the gross profit. They have a very high gross profit margin. I actually did some I did some fundamental analysis. I did a vertical and horizontal analysis, which we'll look at in a second. But this company is a United States-based company engaged in the software business. It has built a cloud platform, Cloud Future 10X, that delivers a range of network services to businesses. The product offerings include Argo Smart Routing, load balancing. You're going to be getting a load if you buy this stock. Web optimizations, mobile software development kit, Cloudflare Access, and Spectrum. So I don't know crap about IT. I never claimed I'm a genius or, well, okay, maybe I am a genius, but I don't know much about technology. I'm not a techie, okay? I'm an accountant. I like numbers. I like business. I like debits and credits. I know. It's hard stuff. It's rocket science. So I went on the website, and I just kind of looked around. So it looks like they provide like internet security options, and they help companies, manage their software. That's what I get from a company. I mean, I can't claim that I understand exactly what they do, but they have, API Shield makes massive Cloudflare global network your security. So they provide security software. They stop bad bots, so bot management. They block DDoS, I guess denial of service attacks. Page Shield stop client-side Magecart and JavaScript supply chain attacks. So it just seems like it's basically a bunch of software that protects businesses. Now they have a couple pricing models, and I thought they had a better layout than this that really showed the pricing, but I guess not. So they have a free level. Here it is. So they have multiple tiers for based on whatever you need. So small business, obviously you don't need to be paying that much, and large business like an enterprise, yeah, you might be paying a lot of money. But they do have a free option, and they give you, certain perks depending on what you pay. So you can pay $0 a month, probably don't get crap for it. $20 a month for professional websites that aren't business critical, like Strongman, personal finance. Business for small businesses operating online, $200 a month. I mean, even if I was a small business, like $200 a month is a lot. And enterprise for mission critical at the core of it. So this is for large businesses, and it's customized. So basically, they could be paying a ton of money. So that's kind of what they do, okay? Application services, zero trust. I don't know crap about software. What I do know is the numbers, okay? So just looking at this chart, I'm not a technical analysis guy, but it seems like this stock has just had a massive freaking run since, well, I guess it only goes back to 2019. So 2019, let's see when the run started. Let me guess. Was it the pandemic? So the pandemic starts in early March, at least in the United States. And then basically after a while, the stock just freaking rockets off. And it actually really started kicking off on October 1st, 2021. So this stock is definitely spiked. And it's probably caught people's attention because it went up, bro. Went up, bro. So, but the metrics are trash, not profitable, no PE, no profit margin. Gross margin's good, but if you don't have a bottom line profit, that doesn't matter. All right. Now, a little bit more about where they sell their products. So they're actually not just based in the United States. Like they do have a global presence, which is an encouraging thing. Okay. So as of 2020, the end of 2020, 51% of their revenue came from the United States. 25% came from Europe, Middle East, and Africa. 18% from Asia Pacific. And 6% other, like Mars or something. So they are a globally diversified company. And that makes sense because it's a freaking software company. All right. So what I did, let me close this HIMSS documentation. So what I did is I downloaded some financial data from the Securities and Exchange Commission. And I'm able to use this data, specifically income statements, those recent quarterly statements, and the cash flow statement to kind of figure out what's going on. What's going on with this company? Why are they not profitable? What's causing this company to lose money? So here we have, in this column right here, column C, we have the financial data for the 3 months ended September 30th, 2021. So if you look and we zoom in a little bit, you can see over 3 months they had revenue of $172 million, cost of revenue of 37, and they had a gross profit of $134 million. So very, very high gross profit margins. However, they have very high operating expenses, sales and marketing, research and development, general and admin. Those three combined take them from a high profit at the gross margin level down to a loss from operations. And then from there, they had some additional charges, but we'll look at it piece by piece. So you can use vertical analysis where you take each line item of the income statement and you divide it by the revenue to get the percentage of sales of each item. And you can kind of look and see, okay, what's the largest expense of this company and how much has it affected their bottom line profit? That's what it's helpful for. Horizontal analysis here in the green on column E helps you compare year to year. So in column F, I have the 2020 data for the same time period, and I can see how stuff has changed. Are they spending more on this as a percentage of revenue or less on this, stuff like that. So let's look at the margins. Most recent quarter, 78% profit gross margin. Pretty freaking good. 15% loss from operations. Now, the biggest expense by far is sales and marketing for their, a normal recurring expense is sales. So they're really pumping a lot of money into sales and marketing. Now, if you compare that to the previous year, well, they were spending about the same. So they're still spending a ton of money. Basically, half of all their revenue is going into sales and marketing. The remaining amount, 27%, is going into research and development, and that stayed consistent too. The only expense it seems to have gone down as a percentage of revenue is general and administrative. So that's good. They're probably cutting, some fat, but it definitely makes sense for a company that's new and growing to be pouring so much money, half of their revenue into sales and marketing, and a quarter of their revenue into research and development. All right. Now, one thing that really annihilated their freaking profit margin, because they actually had a negative 62% profit margin on the bottom line. The reason that happened is you can see this big number right here, loss on its extinguishment of debt. That is a one-time loss based on, I guess they issued some debt and then they bought it back at a much higher price based on whatever the provisions of the debt were. And that freaking generated a massive $72 million loss. So really their margin isn't negative 62%. Okay. It's probably closer to, negative 20%, which is still freaking horrible, but it's not negative 62%. That's a one-time charge, this right here. You compare that to the last year over here in the yellow, their loss was negative 23%. So that's a little bit more accurate because that's excluding, this one-time charge. So We can actually figure out. So if this charge didn't happen, let's see what their, yeah, they would have had 20% loss margin. So whatever. So losing money like freaking crazy. Now we go to the bottom here. We have share dilution. Okay. They've diluted by 4% year over year. Not horrible, not as bad as some other companies, but they have diluted shareholders. All right. And you can do vertical analysis for each year. So you can compare year over year over year over year. On the right here, I have the 9 months ended 2021 and 2020. So their loss margin over the last 9 months was negative 40%, 15% of which was the loss. So if we add that back, 72235. So over the last 9 months, they've had a loss margin of negative 23%. So, I mean, they're improving. They're definitely getting better, but they're still not profitable. And they may not be profitable for a while. They keep dumping all this money primarily into research and development and sales and marketing, which is half of their freaking revenues. Okay. Jesus Christ. So we go over to the cash flow statement. Let's see free cash flow. Free cash flow as a percentage of revenues over the last 9 months is negative $51 million. Okay. So the vast majority of their free cash flow, well, not their free cash flow, but their cash flow from operations is going into purchases of property, plant, and equipment and capitalized internal use software. Those are the two main things that basically I included in the computation of free cash flow. Those are capital expenditures because it's a software business. So capitalizing internal use software seems like a capital expenditure for a software company. So I said free cash flow, you take the operating cash flow, which was actually positive. It was actually positive, okay? And the reason that is because $40 million of deferred revenue, and they added back the $72 million loss on extinguishment of debt. That's what caused the cash flow to be positive. So, but it's still close to the wire, and it still would have been negative had it not been for deferred revenue or revenue paid in advance. So $51 million burnt in free cash flow, negative 11% free cash flow as a percentage of sales. And the prior year, it was even worse. It was $68 million burned, and it was negative 22% free cash flow as a percentage of sales. So all the metrics are negative, and they barely have positive cash flow. And the reason they have positive cash flow is because of deferred revenue, which is unearned revenue, and it may be refundable. So what do I think about this stock? Do I think you should buy it? Absolutely not. The freaking price to sales, holy crap. 102? 102. You want to pay $100 for $1 of earnings? Are not earnings, revenue? Are you freaking smoking crack? Holy crap. So this company may have potential, but if you're thinking about buying this at 102 price to sales, $60 billion market cap on $588 million of revenue, you're smoking crack. I mean, their revenue is not even growing that fast. It's growing quickly. It grew by 50% year over year. And let's see. Yeah, roughly 50%. Even that, I don't think justifies a price to sales ratio of $100, 102. It's freaking nuts. So I'm giving this stock a freaking F. I would not be surprised if Meat Dick Kevin pumped this stock. All right, let's see if there's any comments. And the strongman's going to bed. You know, to look at the options market to see if synthetic longs are trading at a discount. Meat Kevin is currently losing because he doesn't know how to do that. No, I don't really do options. I mean, I know the very basics of options. I've had to learn that as a financial advisor. But no, I'm not an options trader. Many people think price of the stock term is cheap or expensive. What a joke. Yeah, it's true. Oh, how much is Cloudflare? 100. Oh, it's 191. That's cheap. Any single women in the chat? I'm single there, Porky Pants. No, I'm just kidding. Probably the closest is me since I'm a single soy boy. Yo, strong man. Baba. Hold strong on Baba, ladies and gentlemen. Or sell it. Do whatever you want. I don't really care. As long as you're maxing your tax advantage accounts and buying total world index funds, you're going to be fine. Okay. Strongman, let me come on your live stream later to show people how to do synthetic longs. All right. I mean, if you really know your stuff, I don't mind having you on. As long as you behave yourself. Okay. But I mean, like I said, I don't mind having, people on, but if you don't know what you're talking about or you're just a clown, no. But just email me, okay? We'll talk about it. This company should have a $1 to $2 billion valuation. Yeah, I mean, I think a price to sales of, 50%. It's so hard. Maybe like 10, maybe. You know, something like that. That seems more reasonable. But 100 price to sales? That's freaking crazy. Stock is massively overvalued. Can we get a Tesla? Una Tesla. La Tesla. You like that? Is there any cybersecurity that isn't overpriced? I know, probably not. I mean, I I don't know. Maybe some like old school like security software like Norton's. I don't know. I don't even know if they are publicly traded, but no. Clown. Jeez. All right. So anyway, that's it. Like, subscribe, like the freaking video. Okay. Like the freaking video. I know it's hard. Like, subscribe, tell your friends about me. Buy my book. I actually raised prices on my book. I increased them by like $2. I want to profit more. And y'all have a wonderful night. Rivian, let's see. Last comments. No clowns. I meant, is Kevin a clown? It's okay. No, nobody. I didn't think you were making fun of me. Is Kevin a clown? Yes, he is. He's probably watching this live stream. Oh, I need to learn about how to actually analyze stocks. Strongman, can you teach me? All right, I'm going to bed.